Ladies and gentlemen, welcome to a mid-market madness stream, let's say. Okay. I wanted to go live so then we can talk about SoFi stock once again. Stock is doing well, at least coming from, the bottom from where it was in low $17. It is recovering a bit today, but I wanted to talk about why it even went down in the first place, which might actually show us potentially where it might be going into the future. So as I keep a little chart up here, and maybe we'll just do it more like this. I like that a little bit better. I wanted to talk about the reason for it crashing, which was an analyst revision of the stock, which actually was positive. They increased their price target by 50%, okay? But from a base of $4. So they went from $4 up to $6. Yes, we are talking about Compass Point. Yes, we're talking about Giovanni Bologna, I think his name is. Yeah, it's Giovanni, right? Anyway, I have the full report here. And I was going through it and I was just like, you know what? We need to talk about this right now because there is a lot of really positive things that he's saying and very bullish on SoFi, to be honest. The only thing that is extremely lacking is his value, like essentially a valuation of how he thinks that the stock should be priced. I'll just give that away. He thinks that the stock should be based at a 1.2 times year-end 2026 expected tangible book value. Okay, so he's projecting out a forward tangible book value, and that's what he is looking for from SoFi, not any other metric. Okay. One of the biggest problems that I have with this is that it takes away from so much of their other growth, like, for example, the loan platform business, which just was created last quarter. It's what made the stock double, was because SoFi doesn't have to grow based on their tangible book value. So if you want to look at any company by one specific metric and you want to price out what you think that that company should be on based on one metric, then obviously you're going to get some pretty drastic differences in your valuating, like modeling out how much you think that the company would be worth. So aside from that, there are a couple parts in his report that are just really, really exciting, to be honest. In my opinion, I think he's actually pretty bullish. And the first one would have to be his perspective on where SoFi is in their overall loan market share. Okay. So let's go ahead and drop that for a second. We'll return to that, see if any changes have been made. But let's go ahead and take a look at this chart that he has. How can I make this any bigger? Okay. What he's looking at here is over time from Q2 of 2021 up to Q2 of 2024, where is SoFi's personal loan market share taken off in two separate lines. So one is the line here, which is FICO scores above 721. Okay. And then the next one is SoFi's total market share in personal loans, which has now reached a 13.4%. Now, the only thing that I'll question on that I was talking with DDI, or data-driven investing, and he pointed out that based on SoFi's full year, Q2, originations for personal loans, if you were to annualize that out, even taking that very successful quarter, timesing it by 4, okay, then looking at the TransUnion data, which they say they're using right here is TransUnion data, their Q2 numbers were also 149 billion for Q2 of 2024. So 13.4% based on SoFi's total is actually saying that the total addressable market is 125 billion. It's a small discrepancy, but it just makes SoFi look like they're more saturated than they are. If the number is actually 150 billion, or if you're using old TransUnion data where they used to say that and this was just last year, that the full total addressable market for personal loans is actually 180 billion. I think it'll go back to that number, if not exceed it in 2025, that SoFi's total market share for personal loans is actually lower, which is a good thing. Okay. Because essentially what Compass Point is saying is that yes, SoFi has seen extreme success in personal loans, but that can't go on forever. If you have essentially a 30% market share in FICO's above 720, where does that go? Okay. Now, I think it's a little bit different because I think that the total addressable market for personal loans can change based on what SoFi is doing. SoFi does offer a very differentiated product, right? So if you were to look at, let's say, Robinhood, for example, and say, okay, this is the total market share for, let's say, writing options that retail does, you'd think it's actually pretty small. But then Robinhood came in and actually expanded that market share themselves. Nubank too, right? You look at the amount of credit card users in Brazil, super low. After Nubank, like essentially a 5x number. Okay. And the reason is that they changed the behavior of the people that they were serving. So I think that could actually happen here with, SoFi as well, because they treat their personal loans a lot different. They're more normalized debt consolidation products that are, instantly fundable. And maybe there are a bunch of people who potentially would not have taken out a personal loan at all if it was another company, but potentially will with SoFi. Now, I'm just seeing a big red candle here, so I'm going to share my screen really quick. So what's really interesting about what Giuliano Bologna here says is that if we continue to look at their expectations for originations in the full year of 2025 and 2026, it's even more bullish than what potentially they're showing off. So let me close this down. I'll continue to monitor it on my other screen. But what I want to show is this next chart that they end up showing off. Okay. This is the personal loan market share that they're showing off. And if you look at these lines. So it's pretty hard to essentially get what the billions of it are, but let's do our best. So we know that this line right here is essentially 4.2 billion. And if we drag our mouse across, it's just above the 4 line there, it's essentially 4.2 billion, right? Q3, same thing, very positive quarter, about 4.8. That's where it lies, right? But then as we go along, they are expecting, like in Q2 of 2026, like nearly 6.6, maybe $6.7 billion of originations per quarter. For a $6 stock on SoFi, they seem extremely bullish on SoFi's ability to continue to increase their, personal loan originations. Now, they even go on to say that they believe that SoFi is going to take more market share in home loans. SoFi is going to be extremely successful in student loans. And they also suspect that SoFi's technology platform is going to accelerate growth as well. So here, let me find that, because that was a very interesting one. They said, we believe that in full year of 2025, technology platform revenue will grow to 19.5%. And then in 2026, it'll grow by 26.5%, with margin improvement in both years. So they're super positive on the technology platform. They're super positive on all lending, which, by the way, they also use a little bit of a falsity, in my opinion. Like they talk about, even financial services is becoming a lending platform, which is true with the loan platform business, but that the whole company is essentially made up of lending revenue, right? That isn't true. Okay. Yes, it is a large part, and the loan platform business makes up for even more. But you cannot discount how fast financial services has been growing. And if you only look into the past years and say, okay, this is how they're being sort of portrayed, then you don't get to see you don't get to sort of project out a positive number into the future. An accurate number into the future. So financial services is growing. The amount of SoFi Invest users, SoFi Money, credit cards, those are growing, okay? So they are not pricing in any of that at all. The only thing they're doing is looking at a multiple of tangible book value going forward, which is so silly because we literally don't need to grow our book. Now, there's some comments in this report as I read it. I have it on my other screen. I am not going to show you it because I think I don't know if it's a legal thing, but I think there's a reason why no one ever shows it. But I can just quickly show, maybe just for a second. I do have it in front of me. Okay, so I will be going through it, but let's just hold on a sec here. Okay. There's a couple things that they say. So one of the reasons that they don't like the company is that they believe that SoFi is going to do another capital raise. They've been so open about the fact that they are not doing that, that like they would be going so against their word. Yet there's a bunch of these $6 analysts that continue to say that this will happen. There's no reason for it to happen. They don't need to grow by their tangible book value. They won't need the extra liquidity as long as they can find partners that are actually going to write their loans for, or that will use their capital to write loans for them. So I don't believe that. They believe that the market share growth of being anywhere above 15% in total market share in personal loans is a very dangerous place to be. I do think that, we can't continue to grow the total amount of market share in SoFi. They're not going to take over the full personal loan market, but it is higher than 15%. I think the 15% is arbitrary. And especially whenever they're giving out all these loans to other companies, that you can't use the old metrics of banks that are growing on their own balance sheet with this new style of giving it out to other institutions. So, yeah. Let's see here. It was really funny. This is hilarious. They said their late stage delinquent loans are getting worse and worse. Okay, so one, talk about cherry picking. Okay, they're talking about the smallest aspect of their growth is not doing as well as what it was 2 quarters ago. And then the great Vadim on X ended up breaking down all the numbers that we know and comparing the late stage delinquent loans. So let's go ahead and show that really quick. This is essentially what we broke out. There's only been 3 quarters of late stage delinquent loans that have been sold, but essentially what you're seeing is larger and larger sizable loans. So whenever you're actually looking at the realized losses, they are increasing. Okay. But the gain on sale margin is actually improving every single time. So these are late stage delinquent loans. We've already written them off. We're not supposed to see any return on these loans. These are people who are not paying us back. Okay. To get any return back is the benefit here. And in fact, SoFi is actually seeing about double the benefit that they would doing this route than trying to go through collections themselves. But even on a quarter over quarter basis, these negative rates are lowering. Okay. So I just find it funny. Some of the things in this report, it's like, okay, one, you're looking at a handful of problems that, one, I don't even believe are problems, or they're so small of problems that you're just missing the picture. Imagine not wanting to invest in Google because they might be having problems with Google Chrome. Okay. Divesting from Google Chrome is the biggest issue there at Google. Really? That's the issue. So you're going to give up on a, essentially multi-trillion-dollar company because they have to divest from Chromium. I think that's sort of the late stage delinquent loan setting here, or the idea that fair value is not necessarily what they believe is fair value, and that it's potentially way worse, even though companies like PGIM, like Fortress, like BlackRock are buying our loans in droves. You don't think that they can see our fair values, that they're doing their own modeling of our loans, that they're buying billions of dollars and they think that our loans are crap? Come on. All right, let's bring up the stock once more. By the way, congratulations to Netflix holders. Great quarter, but ARM, Oracle, where's my NVIDIA? NVIDIA, whoo, gotta love it. Even though SoFi is down, it is a good day for me. Let's see here. I just want to get back to, did I see Robinhood really quickly? Let's take a look at Robinhood. I could just search it. Robinhood at $50.62. Incredible. It's going to bring a tear to my eye. Very nice. All right. Let's see some comments here. Tanner, you should do some more mid-market madness. I love this. Good. Yeah, I had a topic to cover, so I was going to record a video, and I was like, I'm too lazy to edit, so I'll just go live. It's a little less formal, but at least then I can answer your questions and kind of does the comment section and the content in the same video here. Who's buying at $17? I mean, a lot of institutions. It depends on what you believe is going to happen for 2025 or 2026. If you take a look at their PEG ratio, depending on your outlook of the PEG ratio, but even if you take management's, you're still less than a 1 times price to earnings growth ratio. Okay. So if that's the case, and you're looking for a company potentially in financial services, what would you rather hold? Do you want Bank of America or do you want SoFi? Do you want more of the old age value play, or do you want potentially a younger pick and sort of a growth play? I think it depends on, your outlook and in your investing strategy. How do you feel about Shift 4? Yeah, where's Shift 4 today? Because they were running a couple days ago. Shift 4 116. That's a good price. I'm sort of on the fence with Shift 4. I got invited to their investor day, so I'm going to go meet Jared Isaacman and the team, and I'll definitely let you guys know after that ends up happening how I feel about it, because I'm going to know a lot more about the company. I'm going to get to talk to some employees, everything. So like I said, if you guys are in the Discord, go to the Shift 4 tab and put in your questions, because I'm going to be going around asking everyone a ton of questions. If you have any questions about that company, let me know, because yeah. Is this an everyday thing? Probably not. They're fun markets right now. Things are moving like crazy, so I'm actively watching. But I don't usually actively watch the markets, especially like this on a minute-to-minute basis. But for SoFi, it's a lot of fun. We're really, at a high valuation in the last 3 years, the highest in the last 3 years. So it's a lot of fun to watch. Is SoFi still worth buying now at $17.50? I mean, it's up to you. It's up to you. You need to do your own valuation breakdown of this company and see, right? If you have capital to deploy, what else are you buying? Is there a better investment than this? Or if you don't like another company, if you don't feel more comfortable with another business, is this the right value? Do you think that 2025 and 2026 has the right amount of growth that potentially could propel this company versus expectations? Yeah, it is weird, Sam. They have been wrong significantly, and it must be sort of spit in the face for this company to go from $4 to $6, because Bloney was on a podcast 3 months ago talking about how SoFi shouldn't even be valued at 1 times price to book ratio, and now he's pricing it at 1.2 times. Forward-looking price, way ahead of where he just was talking crap whenever the stock was down at $7. So easy to bash the company whenever it was there, but now that it's extended, it's almost like he's playing catch up. Now, to be honest, I don't like the way that he values this company. There are a lot of things that he actually does say right about this company. I think that he's right about the growth on originations, on the tech platform growth. There's a lot to be bullish on from Giuliano Bologna, and so I'm not here to just pick him apart. I just think that the way that he's actually valuing the company, saying, "Oh, we have to look at it on a price to tangible book ratio," is silly. Okay, go to Upstart and price them versus their tangible book value. Why does that make sense? Why does the company with a technology platform with a financial services segment growing 100 plus And by the way, he said, oh, well, they're not really growing 100 plus because they brought on the loan platform business. Okay, sorry, 79% year over year, excluding the new loan platform business. Okay, that's still a ton. That's a lot of growth, 79%. So, place that more forward out or forward looking. Like that's going to take up more, like a larger and larger percent of their overall earnings. Now, it does benefit them that the lending platform will also do well, but this is like looking at Nvidia and saying, yeah, but you know what? This company's a data center company and gaming is not going to do as well this year. Who cares? Who cares? We're looking at total growth. How much money can this business make? How fast can they compound it? Right? And there's nothing showing off that SoFi needs to potentially, take it easy on lending or something like this. It's just not the case. There's all these other sort of like looming ideas that I'm even thinking about with SoFi of like, I just had this question posed in one of our group chats, and someone said, what if Trump gets rid of the Department of Education and these sort of federal student loans start to get owned by the states, right? What happens then? And I'm just thinking like, okay, SoFi actually services their own loans now privately. Before that was done by Mohila, which is one of the largest servicers of federal student loans. Can SoFi then start to get into the bidding of federal or statewide student loans? And then not only that, potentially this actually, widens the gap between what government loans could potentially be offered at and what the private companies can potentially offer them at. So student loans, I think that there'll be a big opportunity there for them. I think that home loans is one of these ones that are just going to continue to grow, be held back by nothing. They're the tiniest percent of total addressable market of the total market share, sorry. And the only thing that they need is more data, more underwriting. The one thing that SoFi, we have to remember, is that they were not a personal loan business. They were a student loan business. And they grew to like 60% of all private student loans, way higher than what Baloney thinks that we can get to in personal loans. We did it on the student loan side. And now, like whenever we originally started getting into that, like the 2017 vintages of those personal loans were terrible. Okay. They're like twice as good as what they were in 2017 of what we saw in 2024. So they're really, or I think actually the 2022 vintages were better. And the reason why the 2024s, I'm not saying aren't as good, is just because we don't have a lot of data on it. The 2 years of the 2022 vintages were better. Anyway, the only thing that I'm trying to express is that the longer that SoFi ends up staying in one lending category, the better they are at doing so. SoFi acquired Wyndham Capital Mortgage like 12 months ago, 9 months ago, something like this. We're just getting into that field. We have so much more to do there. We have so much more to do on the credit card segment. We have so much more to do even on the personal loan and student loan segment. But this idea that SoFi is going to be potentially halted by their market saturation is crazy to think about whenever you're thinking about financial services. It's just the beginning. SoFi is not going to take in all the money that they've found from, personal loans and student loans and everything and just rest and say, oh, you know what, we're going to give a dividend now. No. Anthony Noto wants to be a top 10 financial institution. Okay. They need to sprint to take on more market share in different areas. So that's going to be banking. That's going to be deposits, right? You're going to get into SoFi Invest. Then you look to get into small and mid-sized businesses. Then you get into working capital, like business loans, not just in referrals, but underwriting it themselves. Then look at the loan platform business and get into loan platform business loans. They already do that. They have a marketplace for business loans. They just don't underwrite. Okay. So all of these different things, they are connecting the broader financial institution with their own technology, which runs on essentially two rails. One is the loan platform business, which is a connection of all these institutions and their own clients. Okay, so whatever they can't do, they will then give out to a larger marketplace of institutions. It's not just for personal loans. They do a lot of referral-based stuff with Pagaya and different credit cards. Potentially, if you guys have ever signed up for, a SoFi credit card and you've got rejected, okay, they might say, oh, you know what? This credit card doesn't work for you, but maybe you want the Chime secured credit card. Chime? Where did Chime come in? That's their marketplace. So SoFi is getting paid for you signing up for a different credit card. Take this even further, okay? That's the referral, that's the marketplace. This is their, segment that they're going to grow in way faster than a bank. That, like, people who say they're just a bank, no, they're a marketplace of full financial services. Then on the other side is the technology platform. This is connecting financial institutions to the back-end technology and also setting up their card programs. So you can go to a new fintech like MoneyLion, like Dave, like Chime, like Robinhood, and say, guys, we're going to set up your full back end. You currently, although you're in brokerage, although you're in these areas, even interactive brokers, for example, they're a client of Galileo's. You say, you know what, you're in brokerage, but why don't you allow people to spend what they have left over? Wouldn't that be amazing? So then they can tap, or they can go online and invest, or they can buy something. That's beautiful, okay? That's on Galileo. And then imagine if you can then take those same businesses and say, hey, you should start getting into credit products. This is where the money is made, is in credit, whether that's credit cards, personal loans, student loans, whatever. And we will underwrite them for you. You have zero expertise in this, but you have 16 million clients, okay? Start offering them those. We'll underwrite them. And then if you don't want them on your books yourself, we'll end up selling them for you. We'll give you a percentage of the origination of your own client. And then either ourselves will take a cut, and then we'll give the institution the rights to the actual loan performance. That's the future of SoFi. Okay. 2 digital rails that have absolutely zero to do with tangible book value, for which Giuliano Bologna thinks that we need to be at 1.2 times that. Another manipulative bad rating. I mean, it's just weird. Like, I actually think he had a lot of positive things to say about the business. A lot of people are just getting in right now to the live stream, but like, he said a lot of very bullish things. He thinks that there's going to be quarters where SoFi does $6.6 billion of personal loan, total originations. But what's it called? Yeah, it's just very weird. No, sorry, just personal loan origination, 6.6 billion in a single quarter. But then it's the way that he values it that's weird. It is weird that it came out whenever SoFi was $18.10. I think it's to make his report look better. So if you actually look at the report, it tells you what the stock price was whenever he made it. It says $18.10. Like, okay. Isn't that the top of the open markets yesterday? Yeah, that's the absolute tippity top. So I think even if it falls a little bit, it'll be like, see? I don't know. Let's see what some of you guys are saying in the chat here. Home builder here. Got to compliment Tanner on his self-installment of the new acoustic wall. Well, I didn't even finish. I just stopped because, so give me no compliments. I've got them here. I got to put them up, but I just have stopped worrying about it, to be honest. Yeah, it was a $6 price target, by the way. $6 up from $4. So where'd you find that 50%? What changed? And what's stopping you from adding another $10, $12 onto that price target. We still got to triple from here, Baloney. Then we'll be friends. No, honestly, to be honest, I've spoke with Giuliano a couple times. It's been nothing but nice to me. We just differ. But we don't have to agree. You know, I don't like the price target that he has. I think that it's wrong. I think the way that he values it is wrong. They keep harping on this fair value agreement. I think it's absolute silliness, considering that you can just see how many institutions are buying our loans. Like I said, BlackRock, Fortress, PGIM, which is a $1 trillion, fixed income purchaser. It's insane. Not only did they buy SoFi student loans, they came back and bought another larger, it was like 60% larger, or sorry, it was $325 million. Then they bought another $525 million securitization from SoFi. Why would you do that if the first ones were all filled with junk and that it was a fair value nightmare? That seems weird, doesn't it? So, in my personal opinion, we've been fighting off these reports of the fair value nonsense. I literally spoke with the guys at, what was it? What's the name of their company? They were in that movie. It's going to drive me nuts. Porter Collins and Vincent Daniel. Those two guys went off and created Seawolf Capital. I ended up meeting them at the Robinhood Miami Investor Day thing, like the big event where they showed off their index funds and everything. The Hood Summit, that's what it was. And they knew who I was. They follow me on X, and they were like, dude, we appreciate what you do, but SoFi is like not a real business. Like, they were like, hey, just so you know, their accounting is like next to fraudulent and it's absolutely fake. I'm like, okay, I'll be nice. You guys have seen whenever I've debated people online. I'm not there to just throw it back in their face. But they are getting loan purchases, real loan purchases from the largest financial institutions in the world. BlackRock, okay? PGIM, Fortress. These guys are some of the largest asset managers and financial institutions in the entire world. They are not buying fraudulent books of business, okay? SoFi is doing everything by the book, and they're literally regulated by the Federal Reserve, the Office of the Comptroller of the Currency, the SEC. You'd have to be the greatest mind to fraudulently cook your books like that. Okay? And by the way, even the businesses that they do look towards, they go, oh, you know what's a really good business that you should get into, Tanner? If you really want a real personal loan lender, get into Lending Club. You know what Lending Club's been doing? They've been getting, like, a lot of their new loans, they've been valuing at fair value. They're doing what SoFi's doing. A lot of it. Now, they were doing, like holding to maturity, but now they're changing. They're holding for sale, fair value accounting, and doing what SoFi has been doing at larger and larger rates every quarter for about the last 4 quarters. Let's take a look at SoFi's price real quick. There we go. I like staring at it. I'm not doing any crazy price predictions here. That's not what I'm saying. I just, I think an easy way of valuing companies, I like to look to a lot of the great investors, great growth investors. If you guys know me, or if you've seen the growth investing course, that you'll know, like, I don't divvy off from a lot of the great investors of how they value companies. So I look to Don Valentine, I look to Peter Lynch. I like these types of investors. And one of the things that Peter Lynch always says is to value a company, you look at price to earnings growth ratio. This is one of the most consistent ways. It's his favorite value metric. And if it's under 1 times, you could potentially be seeing an undervalued company. And if you see it over times, you could potentially be seeing an overvalued company. Now, there's a lot of potentially, okay? It's not a guaranteed way to understand a business. But SoFi's linear growth, and I mean like truly linear, like you can just look at all their charts. They do this. There's not a whole lot of fluctuation. It's just straight up and to the right. Okay. Those are the types of businesses where I really like to look at their price to earnings growth ratios and just be like, okay, this is what they're expecting through not only full year of 2026, but also the full year of 2027, as we know that they want to grow essentially between 20 to 25% on EPS for multiple years thereafter. Okay. Take those future growth rates and price that into where SoFi should be going forward. You're getting a price to earnings growth ratio of less than 1 times at this price, not at 6. See, this was the thing, is it was a lot easier for me at 6. What's so funny is people were even more bearish back then, but it was freaking obvious to me. Now it's still undervalued, but it's closer. It's much closer to fair value than where we were at 6. And here's the thing, is that SoFi is going to be reporting Q4 numbers, and then we're going to have to adjust price to earnings ratios because the price may stay the same, but the earnings are going to get better. So if we actually don't go up on earnings, the companies get cheaper, right? So the idea being is exactly what happened with Netflix. You show better earnings, you get a better price. You beat on earnings, you go up. Okay? Because the earnings were higher than expected, and so that's going to change the price to earnings ratio. So then you readjust the price to meet the value. Galileo will impact the price multiple. Yeah, I mean, I don't even think that the price multiple conversation really matters now with the loan platform business. That is essentially a tech multiple. We're not taking on any risk, and we're selling things for commission. That's fee-based revenue. How's that any different than Galileo? So the real change in valuation for SoFi changed in Q3. And if we just go back a little bit, we'll just go back 1 year. Right here in this blue line, let's bring this a little bit bigger so you can see. This blue tick right here is earnings. So this is where they gave out earnings. You can see how the price of the stock has changed over the last 2 quarters, but mainly the last quarter. Okay. So you have a lot of, from Q2 to Q3, you have a lot of like interest rate change conversations. And then I think here, especially all the way up here in this last push here, is all revaluing the company as we realize that tangible book value is not needed. And now we might be pushing out a little bit of money today as we go from 1820 down to where we are now, because a report comes out saying, oh guys, by the way, this is a $6 company. This is not to mention they increased their price by 50%, but this is deserving of a 66% cut. Relax and look at what brought us here in the first place. If back whenever we were at 6, you said, or at 7, and you said this was a $6 stock, I would have said that was ridiculous. To say it now, it's like, all right, cool. First time that I'm able to join your live. I'm from the Netherlands. What time is it in Canada? Essentially 2 p.m. Eastern Standard Time. Dookie Pie is here. What's up, buddy? From the Robinhood Weekly. Good to see you. That was the name that I said on the Robinhood Weekly, and the Mitt laughed for like a straight minute. Yeah, these reports can be absolute garbage. How's it going, guys? Any questions on this or any other report? Anyone buying Robinhood here? I saw that Amit bought in the $50. He's a little bit more brave than me. Although I do think they can continue to run higher. I've got other things that I'm buying right now. Big fan of big tech right now, to be honest, which is hilarious, guys, because like Nancy Pelosi, I mean, honestly, like I don't know if it's her, I don't know if it's Paul Pelosi, they all need to get locked up. Like it's just straight fraud what they're doing. They're investing in all these crazy AI companies, betting against Apple and putting all their money in Nvidia, Google, and Amazon. Now, I did that. Okay. I've been saying buy Nvidia, Google, and Amazon. That's what I'm doing. Or at least that's what I'm buying. And then Nancy Pelosi ends up doing the exact same thing right before the Stargate project was announced. She was even buying this crazy healthcare AI company that's going to help, potentially turn mRNA vaccines into, cancer vaccines and, or like, these sort of crazy futuristic things that we're getting into and betting on these tiny companies. And then here comes, Larry Ellison. Why does that name sound weird? Yeah, it's Larry Ellison, is it not? Am I going crazy? Yeah, I don't know why I for a second thought that his name wasn't Larry. Yeah, Larry Ellison then comes out from Oracle and says, "Oh yeah, by the way, there's these companies working on, folding proteins that are going to help with mRNA vaccines and all this healthcare crap that I don't follow close enough." Yeah, Tempest AI. It was Tempest AI, and she put a bunch of call options on it before this news was announced. Like, I mean, just like actual like lock her up. No, I've always known that she's had a crystal ball. It's just so funny how like over the last like the fact that she's had a crystal ball, I feel like has been really had a spotlight on it in the last 4 maybe 5 years, okay? Before that, it was like everyone knew that she was unbelievably rich, but we didn't quite understand the performance of her trades, before it really started to kick off. I forget who started to point the finger at this a long time ago, whether it was Chamath or something like this, but one of these guys were really harping on this point. But then it became full focus. I think she even stood in front of a committee and had to talk about her trades and all this stuff. She goes, "Oh, it's not me, it's my husband." I don't know. Anyway, it's crazy that these types of huge block trades are still being done days before Stargate project actually gets announced, which is funny because Elon Musk is sort of bashing the, understanding if this is even real or if the funding is even there. He thinks that Masayoshi Son potentially only has about $10 billion secured. Microsoft, Satya Nadella is saying, okay, but we don't know where the other 420 billion is coming from, but we know that we have our 80, right? And it's just, who knows? All I know is that Nvidia going forward will be a massive benefactor of all the changes that are going on, not just for the next 4 years, which is essentially what this is going to be played out on, but over an even, longer length of time. But I am so like almost scary bullish. Like if you're talking about on a feed, what am I trying to say? Fear and greed scale. I'm very greedy right now. I think that this is not a .com bubble. There's so many things happening all at once. This is not a single, movement. You can look to so many different advancements all at once. I think that Cathie Wood, as much as I bash her investing style, as much as I tear apart her performance, The one thing that she gets right, and the only article that I'll read of hers every year, is the Big Ideas report. Because I do think that they're right. I do think that they understand what the next big movement is going to be. They were right on cryptocurrency. They were right on, you know, all the healthcare benefits and all the AI advancements, robotics, self-driving autonomous cars. They were right on all of that. Their ability to trade on all that nonsense was something else. like it's like they saw the future and then they went, okay, let's buy Zoom. Let's buy, what was it? Teladoc. Let's buy just all the stuff that didn't align at all with what they thought were going to be the big breakthroughs over the next decade. Like, you think AI is going to be the biggest thing? Somehow she lost money on Nvidia through, massive growths over the last years, and bet heavily on Zoom. What part of Zoom fits into your equation? Okay. I don't know. Does the Compass Point report indicate if they're long or short? No, I think it's quite the opposite. I think that they say, here, let me, I'll try to just quickly search for it. It's actually one of their risks for being anti this company is that SoFi's elevated short interest could lead to short squeezes, pushing the share price higher. By the way, I also have their EPS targets for full year 2025. They have it at 29 cents on a diluted basis and 47 cents for 2026. 47 cents. Okay. Let's see here. Let's see if they're short. Compass Point and its respective directors, officers, employees, and members of their immediate families may have a long or short position in these securities. But no, they don't talk about having long or short. It's just a sell position, sell rating. Okay, let's see here. And then let's go. Ooh, baby. Ooh, baby. All right. There we go. Okay. Which report / clown came out with a new rating? So it was, honestly, a lot of the things that he had to say was, in my opinion, either right and extremely bullish. Like, there was a lot of things that he said which were really bullish. He believes that tech platform growth is going to be way above 20%. Margins are going to improve. The amount of personal loan lending is going to continue to skyrocket. They're going to do well in home loans, student loans. They said a lot of great things. It's the way that he valued the company was silly. But it was Giuliano Bologna from Compass Point. When is SoFi getting into the S&P 500? S&P 500 inclusion requirements actually increased. So it's now at 20.5 billion, which means that SoFi is no longer eligible. We're just shy of 19 billion at this current price. So we got ways away. If it happens in 2025, cool. Most likely it will be a 2026 thing to happen. There are a lot of amazing companies that will get in before SoFi gets in, like Robinhood. Robinhood, if I were to venture to bet, they will be in very soon. Did I add more new? No, I did not. S&P 2026, I think. Yeah, I think so. Zoom to 1500, bro. Mark, good to see you, man. I haven't seen you in a while. Let's see what else. I'm zooming back up because usually whenever I get in my tirades, I don't read the chat. Well, Kathy Wood was buying a lot of SoFi and then she sold it and then it continued to run. So once again, like good trade, bad, or like good investment, bad trade. Whoever is actually like the buyers and sellers of the ARK funds needs to get canned. And the people who actually do the research at ARK's company need to, I mean, I'm not going to speak for their own career decisions, but just divest and do your own thing. Like, I would read those reports. I do read those reports. It's the only report that I read from ARK Invest is their big ideas every year. Every year for years and years now. I feel like SoFi holders are baggies. I don't know what that means. I feel like I said a bad word and I didn't know that I said it. Yeah. I mean, guys, there is so many great stocks out there. I know a lot of people look to how much a company has moved to decide whether that they want to buy into it. I know that there's a lot of people that always want to catch those 2, 3, 5x baggers. And I just, during these really bull markets, for a company to still be held down, there must be something that's going on. Okay. And there could be alpha there. There could be a real misunderstanding of the business. I think SoFi went through that. But there were also real pressures to SoFi too, like the macro environment, the rate hikes. Those were real. But yeah. I also don't think that you need to look to these unknown tiny names to make great money in the markets over the next years. Now, I saw someone with a name, their handle or whatever is like the patient investor. And I was like, man, I should have named myself that. Because the truth is that I really am wanting to look at my portfolio in a greater timeline. Okay. So it's not just about, wow, big volume just there. What's it called? It's not just about looking at the companies in the short terms. It's about what are the grander sort of pictures that are going on. And there's one sort of change that I'll never ever bet against, and that's digital. Like that's, there's going to be more cloud compute, there's going to be more semiconductors, there's going to be more online banking rather than cash. Do not bet against people going more online, digital. That also includes all the safety stuff that you'll need for that as well, cybersecurity, all these things. It's like one of the easiest trades, and people can talk about what they think the valuation of these companies are going forward. I mean, people have said that Apple is overvalued for, years and years and years and years and years. Okay. If there's one thing that all of these tech companies have in common is that they have total addressable markets that are expanding. And even if they are losing within those total addressable markets or in their market share of those markets, the total market is growing, which usually means that they can still end up growing regardless. I'm outperforming on my portfolio, but it's not because I'm the best stock picker or anything along these lines. It's just I just buy companies that I know have great tailwinds over long periods of time. And if you're looking at a company like SoFi or Robinhood, and you're wondering where the money is going to flow through over the next few years, talk about the great wealth transfer or something like this, these guys will be great, benefactors of those businesses. And the unbelievable advantage that the great banks have had for 200 plus years, like Citigroup, of getting branches and the cities growing around the banks that are already there, and that they have those pieces of real estate, those are essentially going to be valued near zero. I mean, they are billboards to show off and remind people that those brands exist, but you don't need them anymore. That 200 years of IP isn't worth anything if you can log on and trade without paying for those branches, by the way. Robinhood operates their business cheaper than the big banks. So you can actually go and benefit from being online, operating these new businesses, using them, and potentially subvert a 200-year-old growing IP. Like, I wouldn't bet against that. I would not bet against the idea that it will continue to grow. And not just on consumer banking, on business, on wealth management, on debt markets, everywhere. Any scenario where you see SoFi being bought out by a bigger competitor? Yeah, of course. I think SoFi is, growing quickly, and I've always said, like, Wells Fargo, Citigroup, one of these companies with sort of a lackluster customer experience or net promoter score should acquire SoFi. Like Wells Fargo, especially being the lowest out of all the big banks, should acquire SoFi. But then you see them and they take $30 billion, which would have been a really good bid for SoFi at 7 or 8, and they bought back their own stock. And I think what's funny about the difference between having a founder business and having a business that's ran by a new CEO is that I don't think the CEOs of those businesses care at all about the legacy of the businesses that they're running. What they want is a paycheck. What they want is a pension. What they want is to know that they're growing their wealth for their future generations. But whenever you are the CEO of Citigroup, your legacy is not like, oh, well, this is a family-run business, so my kids are going to take over this company. No. It's a board-owned business, and your family is not going to be taking over the business. So there might be a little nepotism in terms of getting them a job or something like this. I'm sure that's going to be the case, but they don't care about the legacy of Wells Fargo or Citigroup or Bank of America. I think the opposite is true for Robinhood, for SoFi, for all these new fintechs, because like David Velez, his name is on Nubank. Okay, he's not making decisions for his retirement. He's making decisions for the business. And I think there's a big difference there. So I think that the really old bank CEOs are making decisions to fill their pockets before they leave. And while they fill their pockets, they fill the pockets of their shareholders as well. But it also takes losing a lot of money to gain market share. Okay? So for the longest time ever, up until just very recently, Amazon was actually losing money on their Amazon, online, like Amazon.com business. Not like if you exclude AWS. So if you just look at them from their like shopping business, they were, essentially making less money every year. But that enabled them to grow their market share and take away from some of the sales that would have been made at Costco, at Walmart, at Target, etc. In order for the large banks to then gain the share back from SoFi, they have to offer an even better product. But they've given those rewards in terms of dividends, in terms of buybacks, in terms of debt pay down or something like this that is going to increase shareholder yield, and they're not giving it to the consumer. In fact, they need to do the opposite. So you see these reports where Jamie Dimon comes out and he goes, you know what? We're going to have to increase account fees. We're going to have to do all these things to consumers because we're losing it over here on overdraft and we're losing it over here on all these areas because they're expecting a certain margin. But margin is just simply going to need to get compressed. And that's why a lot of people look to SoFi and they say, but their margins are lower than the big banks. They're not as good of investments as the big banks. Meanwhile, the deposits are growing at SoFi at great rates, and at all the big banks, they're shrinking. Okay. So there's all these things where it's like, okay, do you want to look at this company on a quarter to quarter basis? Or can we start looking at these companies on a decade wide basis of where is the consumer trend going? Sometimes I feel like every single person on earth invests the way that I invest because I just think like, you've seen all the greatest investors do it. Why are you not following them? And then I talk to people and I go, oh my God, he doesn't see it. I don't get why he doesn't see it. Like at, Gary Gordon, I respect the guy, but this, he freaking said at SoFi at $7, he's like, this is not as good of as a big bank. The only reason why people go to SoFi is because they're offering better APY in their checkings. Like, no, that's not true at all. You can look to many, many banks that offer larger APYs than SoFi, and yet they don't grow deposits as fast as SoFi. So what else is it? What's that intangible feeling that makes you want to use that service over another? Try to figure that out. Like, I don't know. It feels like brain dead to me. All right. Let's see what's moving today in my watch list here. ARM still doing great. Netflix, unbelievable amount of subscribers that are going up. Crazy. But that's going to be the last quarter that we actually see subscriber growth. Oracle, this is all on Stargate project skyrocketing. You're going to also see NVIDIA here, Palantir, all benefiting from these massive investments in AI. Dell, obviously, going to help with a lot of that infrastructure there, SMCI infrastructure. So, yeah, a lot of great moves here. A lot of great moves. Love it. I'm looking at minute-to-minute charts, which I shouldn't be, but yeah, if you guys don't know, NVIDIA is actually my largest holding. As much as we talk about SoFi here, this is my largest play. So I am super bullish on NVIDIA and what they're going to be doing into the future. And even now, like everyone looks back on the like over the last couple of years and they say, okay, well, it's not going to continue to climb because look at how much they've gone up. But look at how much their earnings have gone up. This is why it's so important to sort of take a step back away from these charts. I'm not a technical analysis type guy, and actually look at what the companies are doing. I'm very fundamentally focused and qualitatively focused. So, why is Nubank, the best bank in all of Brazil, or at least priced at that? TSM, Solana. Wow, yeah, that Trump push, that was crazy on Solana, bringing it to essentially 295. Absolutely crazy. Yeah, Trump coin just took Solana so high. I didn't trim or do anything like this. I just staking all my Solana, but would have been interesting. Very, very cool. Let's see if there's any questions in the chat, and then I'll try to answer whatever you guys have for me. There's a really funny podcast that you can go back on of this guy. I don't remember his name. Michael Worden, something like that. Talking about how Open Door will be a much better investment than SoFi. He was really anti-SoFi and like ultra bullish on Open Door. He said it was one of his largest positions. Boy, oh boy, did I disagree. Here's the problem with my my sort of, conversations that I have with people is, I don't like to tear people apart or anything like that. I can disagree, but what they're saying might be opinion based. So I can't say their opinion is wrong. It's their opinion. So I'll listen and then go, okay, I disagree, but let's move on. But yeah. All right, let's see here. Newbie here. Is it still the right time to buy Nvidia, or should I wait for the dip? I don't like to promote like buying stocks, especially if it's a single person asking me to buy a company. I think that the movement in AI right now, in how much investment is going into cloud computing and just essentially all digital infrastructure going forward, is immense, heavy. And I don't know if you will get a dip. I think, Nvidia is not really dipping. What I really think it's doing is being stagnant. And you've kind of seen that over the last couple of months, but their business doesn't look stagnant. So while they make sales and the company's staying flat, that's essentially a dip. Not telling you to buy though. Do your own due diligence. Thoughts about Shopify? It's one of my largest holdings. It's actually not my second largest holding. I've gotten so used to saying it's my second largest holding. Tesla is now my second largest holding, but that was because of, market value gains. I have not bought Tesla in a very long time. But the last time I bought it is like when it was in the 170 area, and that's about as good as it gets. But yeah, I love Shopify. I think that as businesses grow up, they will not want to be on a centralized platform as much and face the large take rates that Amazon has to give them. I think they'll want a sort of decentralized place where they own the branding, they get to own the advertising and everything. All the ways that Amazon gets to make money, those businesses deserve to make that money as well, and Shopify will offer that to them. Best place for soul staking? I just like Phantom, and then you find, a node that you want to work with, and then yeah. I think mine is with Binance right now. So I'm not actually long Joby. So I know that you guys have heard me make some comments about Joby. It's not a business that I follow. There was a Christmas exchange with a lot of our, market friends, and I gave Joby as a gift to another one of the friends of the podcast, but I don't actually follow it. I mean, I could give you like basic market research, but the stuff that I had read on a single article or two. Lucas, I'm not here to help you with your very particular option that you have expiring in March of 2025. I don't know. I don't do a lot of price predicting that way. What I really am here for is fundamental and qualitative research. That's what I really, really benefit on. If you guys ever go to check out my course on growth investing, you'll notice a pretty easy theme pretty quickly. I am a growth investor through and through, have a very hard time with value. A lot of the companies that I buy are expensive, and I've done that because the most important metric that I like is total addressable markets and market share growth. So that'll lead you to companies very quickly, very, very quickly, to companies like Nvidia, Tesla, Shopify, probably even Palantir. I think Palantir falls into that. I just had a hard time with that one. But yeah, I've been known to pay expensive valuations for the companies that I like, and that might be bad in an environment where, value stocks thrive. But since 1990s and beyond, it's been a growth investing paradise, and that's because of a digital transformation. So, I really follow the mindset of Peter Lynch, or especially Don Valentine, and I even go through all of their morals in the, masterclass or whatever. And yeah, just growth investor through and through, and which means that I don't do price targets 3 months out. I do, or sorry, 2 months out. I think about what the companies will be over a long period of time. And some of the oldest companies that I've ever purchased years and years ago, I still hold to this day, you know? Do I hold any S&P? Yes, a very small percentage. It's like less than 1%. And now also, what's so funny about me being a growth investor is one of the things that I do like, because of Bill Ackman actually, is a little bit of diversification as well. So although now not in anything else, I do like crypto, I do like stocks, but I diversify within my stocks. So I've got about 18 names right now, and diversified amongst those 18 names, but you're not going to see too much different across all of those names. They're all very long-term growth picks where I think that they're growing in market share and that their total addressable markets are simply way too big, which leads me into a lot of tech and a lot of finance. We have to remember, retail investors lose money, or they gain potentially 2 to 3% per year, like on average. And it's not because you guys don't know what names to buy. It's because you always want to change something. You always want to make a move or do something like this. It's like Warren Buffett makes all these videos and he's like, okay, why don't you stop doing that and you'll actually make some money? And then people go, no, that's boring. Why is it boring? You know, I mean, I came here to make money, you know, that sort of thing. What were those old original purchases? Shopify, Tesla, and NVIDIA. By far the best trade I've ever made in my life is still one that I'm holding today, which is NVIDIA. I won't say how many shares or exactly what my stock price is at. Oh, sorry, I tried to change this. But I bought in December of 2018. And my problem was I trimmed a crap ton because I didn't buy it for AI. Like those are all new concepts now. I bought it for a lot of crypto mining at the time. That's what was super big, was using those new cards, like, you know, the 10 series, 20 series, to mine cryptocurrency. And during a crash of sort of November of 2018, or I don't know if I'll get the exact timing right, but it was around there. I remember December of 2018. So let's go take a look. It did quite a crash. And I remember being a large fan of Jensen Huang. I always followed the company for a long time. But yeah, right here. So after this crash, I was very, very interested in the company because they did a report, which I'm sure is one of these ones, probably this. And they had shown significantly bad earnings. Okay. And, oh, no, this is not it. Where is it? December. Yeah, sorry. No, it is this. December of 2018. Okay, I don't know why I was getting confused. So once this ended up happening, I started getting really bullish into NVIDIA because I'm like, okay, everyone's freaking out because crypto ended up seeing a bad quarter. But, you know, just because Bitcoin ended up dropping doesn't mean that there isn't going to be more semis and a bunch of things. I was like, man, everything's getting smarter. There's going to be more tech out there. I have to invest. So I started buying this company, buying. And then it just got freaking ballistic after COVID. And all my mistakes on the way up were only about trimming. Okay. I trimmed a lot of NVIDIA on the way up. I'd be in a different place in life if I didn't trim all the way up. And it still makes up for a like, it still was life-changing money, but it could have been a lot different. So, you know, I'm coming up on my 10 years of investing whenever we get to October. So just a little over 9 years. And all my mistakes have only been from it. Well, not only been from investing, but I'd say 90+%. I've picked bad names. I've had those names go down, but like, honestly, trimming good names has been the problem. And never about finding good names. I've never had a problem finding good names. But, you know, bad timing on when to buy, which has never truly been a problem because it's been bad in short periods. Like even I made a video on NVIDIA back when it was like $200 a share post split, so $20. Pre-split, so $20 a share adjusted. And then the company ran down to $15 a share, and people were like, "Oh, terrible video. This stock didn't move anywhere." And now it's up to 150, essentially a 10x from where that was. And now I look, good, but the whole time it wasn't even a problem, and it was nowhere versus where I was buying. I mean, my average is in the single digits, and that's even including after my share purchases up here. I'm buying here. I'm buying here, even though I have purchased down in this area. So I've bought in a long way around here, and I've sold a lot, but yeah. Do I think SoFi has the potential for an NVIDIA moment? Well, I mean, no. But the problem is that NVIDIA, what they're doing is like extremely global and highly, highly skilled. Okay, almost irreplicable. What SoFi is doing is unique, but not irreplicable. If it ever becomes a multi-trillion-dollar industry, there'll be a lot of players being extremely greedy. What makes NVIDIA so good and what was so much better than what I could even anticipate was they had such a unique product. And with CUDA being, essentially their full moat that was impenetrable, they could charge whatever they wanted. SoFi can't charge whatever they want because the product that they're selling is not unique to them. What percentage of cash do I keep? So my cash is fluctuating. I got a little bit of an inflow because I just quit my job recently and sold. I was a financial advisor and sold my book of business. So it's a little different, but I got a little inflow of cash and ended up putting that into investments. And I got sort of a cash tag of about 7%. It's probably about 4% right now. But it'll go down. I sold NVIDIA at $230 pre-AI boom. I thought it was overvalued and would pull back, six-figure mistake. Yeah, I mean, it happens. I trimmed on the way up as well. But I don't know. Do you think that it's now undervalued again? Because a lot of the way that you can value NVIDIA today is similar to how you could value it even back in 2018. Like, it's not that expensive right now. It's just crazy. Let's take a look here. Not at NVIDIA, but at SoFi. And let's go back to the minutes. See where we're at. I just realized I have no drink. Brian, love you trying, but I'm not going to say any actual numbers. I think that has consequences. So I'm doing this full time? Yeah. Between this and my actual investments, yeah. New to trading, what should I buy? Well, that's where you're wrong. I don't trade at all. So I don't know. You're in the wrong chat. Good luck, though. I don't trade. I invest. Big difference. If you're new, you're looking to buy low, sell high, and then buy the next one low, and then sell it high. And in my opinion, traders are few and far between. They lose a lot of money, and then they stop really quickly. Or at least the good ones stop really quickly. And then the actual good ones, like the Jesse Dows of the world. One, I think he holds more than people actually give him credit for. Micro to macro is what you guys might know him at. I don't actually think he goes by Jesse Dow anymore. But yeah, like swing trading, I don't do. I like investing. I like buying companies and holding them for as long as I think that these companies are still market makers. Look at Bill Miller. This is another legendary investor showcase that I'd love to point out to you guys. Bill Miller is a legendary investor. And what did he invest in during his tenure? Any guesses? I'll spoil it for you. Amazon. Oh, what else did he buy? He bought Amazon. What else did he like? Well, he liked Amazon. Now he's getting into Bitcoin. But like essentially, what he realized is that there was a company that had an unbelievable total addressable market. They continued to win each and every year, and it got better and better, and the valuation changed, and he bought more Amazon. And I'm sure he divvied from that plan with other investments. But yeah, all the greatest investors in the world do, like, name me a list of long-term shareholders that have held stocks for decades. My list would be long. Name a list of all the legendary swing traders. The list is whatever, to be honest. There are a couple names, but it's not lengthy. And I'm sure you could find a couple millionaires, but I'm talking billionaires. You know? Okay, ladies and gentlemen, due to a lack of drink that I've seemingly did not bring to myself, I'll let you guys go here. I'm not sponsored right now. The only thing that's sponsoring me is futureinvesting.pro, my website, where I have my courses there. Thank you all so much for watching. I really do appreciate your time. Check out the Discord. Bye for now. Subscribe. I don't know. Get out of here.